Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Economy Show, we're going to look at some key drivers that's happening on a global level. One, we're going to look at trade, what's happening on a global trade level. We're going to look at U.S. data, specifically on some of the new economic data that's come out. Then we're going to look at jobs, our favorite topic. And then we're going to go a little bit deeper on Europe and then overall what the impacts on global GDP are going to be. So here we're just going to dive right in with what happened with the CAS index. So the CAS index came out. It comes out monthly. It's usually a kind of a good gauge of what's happening overall. And here you can see that pre-pandemic, we're back to above pre-pandemic freight levels as the reopening has continued to move. And if you've been following us on our EIA show, we've been really talking about this aggressively, specifically on the trucking side, where we continue to see trucking continue to move. We see trucking miles increasing. Rail continues to see some headwinds, but we have seen an increase in rails, specifically on grain. Intermodal has increased a bit. So this is kind of normal to see if you think about kind of where we're sitting as we backfill that supply chain. The overall problem, though, is we're seeing slowdowns on a country level in terms of all of the stuff coming to the coast. So we still have an increase in exports coming from specific ports, but net, we've seen a decline in terms of just total trade flow coming to the coast, both import and export. So this is something where even though it's nice to kind of get back to these levels, we think it's going to start to kind of bounce around and go sideways as we have some headwinds, that are starting to appear. And when we look at those headwinds, we're just going to talk about the West Coast for a moment, because then we're going to touch on Asia, on why we think some of those issues are going to arise. Here you can see when we're looking at the West Coast ports for the most part, you can see that imports had a nice big spike. So when we start talking about trade balances, you can see China has a big surplus. We have a big deficit again. And it's really because we have seen a big increase in terms of these imports. And now this is a nice thing to see to an extent, where it means we're starting to see some of that backfill. Some of this is delayed, but we're also starting to see a little bit of a normalization. The bigger problem is that dip in exports. So the dip in exports is, again, when we start to marry the imports and exports side, we start to see why, even though some of the data looks pretty good, and we're starting to see some headlines looking a little bit better, on an aggregate, there's still a lot of headwinds that we're going to face, especially when we start looking at some key trade partners. In the last segment, we're going to talk about Germany, what's happening out of Germany and Europe. But before that, because we're talking about the West Coast, let's really look at Japan and South Korea, as we talked about China last week. So when we look at Japan, when we look at the exports overall, you can see the exports continue to disappoint to the downside, as well as imports. And this is just where we're seeing more and more problems. When we think about what is happening on the tech side, what is happening on cars, manufacturing, Japan continues to be the headwind. And when you look at just where a lot of these products would enter the US, that's why, yes, imports have gone up a little bit. But again, it's more coming from China and some of that backlog from China, as people are concerned of how does the Chinese-US trade war get worse? What happens with Taiwan? What happens with Huawei? What happens with Hong Kong? So you're starting to see a little bit of a pull through from China, but it's really not on an aggregate Asian increase level, as we continue to see Japanese exports coming down, which just means that we're seeing less and less demand, specifically on Japan into other parts of Asia, which is going to be an overall problem. And the imports continue to point to not only are they taking in less raw materials, but the local consumers continuing to struggle. So again, how is the U.S. going to export if you just have a struggling local consumer, which is reverberating through the system? South Korea is something where we're starting to see a little bit of an increase. You're getting back towards this kind of normal export growth, which is nice to see. And by normals, like relative terms, if you think about just where we should be on the average, it's surprised to the upside. Again, this isn't the official number. This is just kind of where we're expecting to be. It's still down, but again, starting to get some of that normalcy, which it's just coming down back to, there's winners and losers in this backdrop, where Japan is continuing to struggle. China is being able to benefit, and now South Korea is starting to benefit a little. It's just going to be a matter of how much of it can continue, or is it just kind of that spits and starts? Because anyone who has seen consumer staples, some of these consumer goods, you're seeing, if people are buying new homes, what do you get? New TV. So, what's coming from South Korea? You have Samsung, you have a lot of other pieces of equipment that can come from South Korea that have to move back through. So this is why they're all kind of linked, and why we're trying to build kind of that global picture to look at things, and this is one of those bright spots. Now that when we shift to the US and we just look at some of these weekly indicators, so GDP is just to kind of give you an idea of the base of where we're coming from. And the New York weekly index has gotten a little bit weaker. But again, as we've talked about this specific index in terms of just looking at this New York weekly leading indicator, we think it's just going to kind of go sideways. It's not that it's going to have a big correction lower or this big surge higher. And the PMIs really support that, where we kind of came in flattish, which we'll talk about in a minute. So here we just think that we're just going to kind of bounce around to, going over. And then industrial production continues to kind of waffle just above the trying to get back to that positive level. Again, we're still below zero, but again, the industrial production is starting to come back a little bit. You're starting to see that we had some price cuts get announced in terms of iron ore, some of these others, maybe trying to incentivize some of those movements. But again, it's just kind of this waiting game as we continue to kind of plateau as we go into Q4. Now, this is just looking at some other PMI data and some other ECON data. Now, we just want to touch on first the PMI data at the bottom here, where you can see the survey for services was 54.7. We came in at 54.6, again, kind of right in line, which comes back to where we've had some good data like leading indicators. We've had some weaker leading indicators. And when you mash them together, it's kind of like continue as you were, like everything is kind of moving in a stable place. The problem is small businesses continue to suffer in terms of just lower revenue. Jobs continue to suffer, as now we have a new expiration coming up, which is something that we're going to talk about when we consider, well, with the loss of another $300, how is that going to impact the way people are going to spend? Is it going to get worse? And that's when we start to look at some of these conference board U.S. leading index, and you can see that it's starting to shift lower. That has gotten a little bit worse. Again, it came in right around estimates, but when you think about consumer confidence, the way the consumer is looking at the market, you have to really weigh that with just initial jobless claims and continuing claims. And you can see just how not only are they elevated, but again, it's just kind of that the pace of them coming down is just slowing. And we're starting to kind of getting this flattening effect. And we're starting to see that overhang. And we actually expect to see a little bit of an increase as we go through the remainder of Q3 and as we project out into Q4, as we've already had new announcements of additional layoffs coming through. Now, this is another leading index. When we look at new orders from manufacturers, you can see that it just went negative. So when we think about the aggregate month over month, year over year, this is looking at that month over month leading index. And the fact that it started to go negative, it just means that you're starting to see a little bit of caution. You had things come back quickly. You had that nice bounce off the bottom. Now, as jobs start to come into question, consumer spending, now that you have kids back at school, you're ending that back to school purchasing. You're starting to see some of these slowdowns. And this is something where it's not so much going to accelerate aggressively to the downside, but we expect it to remain negative within a margin of about, let's call it negative 0.5%. So nothing crazy to the downside, but again, something to watch as those concerns continue to increase as we go into Q4. And again, this is looking at those retail sales. Like the retail sales are starting to dip back down, and it comes to we lost the additional $600, which we've talked about, and now we've continued to lose, or there's concern that we're going to lose those additional $300, which again is going to continue to weigh on same-store sales, on the way the consumer comfort index is looking, because people just don't feel as confident. If you don't feel as confident, or if you start to concern about, well, what is my income going to be a week from now, a month from now, 6 months from now? you're going to start to pull back on some of these sales as you've already made up for some of those purchases. And it's really kind of across the board. So this is an interesting breakdown of the data when you look at the University of Michigan consumer expectations. When you look at income over $75,000 consumer and under, you see that there's concern across the board. Things have gotten a little bit better on the under, but on the over 75,000, it's actually gotten a little bit worse in terms of what those highs were. And it's because you were starting to see a little bit of weakness on the as you go higher up the income level, which is again going to kind of keep that consumer relatively on the sidelines going forward. And that's when we start to see consumer confidence versus the equity bond ratios, and you can see just the massive divergence. So it's not a perfect correlation by any means, but it gives you kind of an indication of they usually trend in the same direction. So when we go back to 96, you can see that the trends move generally in the same way, and here we have a big divergence. It's going to be interesting going into an election year. How does this look? What does the stimulus look like? And we just don't think the stimulus is really going to happen in the next, call it 45 some odd days before we get to the election year. So this is going to the election period. So that's why some of these divergences can last longer than they maybe should. And we obviously have the Fed and central banks involved, which is going to keep a little bit of an overhang. And that's when we start to look at, the Michigan real household income expectations. So what do you expect your income to be over the next 1 to 2 years? And again, that's where that move is continuing to shift lower, because even if you have a job, well, are you getting the same hours? Are you getting this, maybe you're instead of working 5 days a week, it's 4 days a week or 3 days a week. Maybe you just accepted a job that is $75,000 below what you initially had. And that's where we're starting to see these concerns. So again, if your income, or if you expect your income to go lower, you're going to spend differently, but you may be happy to have a job. It's just, you're going to adjust your overall consumption. And that's why when we look at consumer sentiment, it's so important in terms of that confidence level, because those incomes are going to be indicative onto that consumer comfort level. And you see that we've gotten a little bit, before we talked about $75,000, consumer over. Here, all right, let's look at 100,000. Let's go incomes over 100,000. Someone where you had a nice little increase, but we're starting to see that, flatten out as these concerns start to arise, as we've gotten new confirmation of furloughs and layoffs at that upper level, where the incomes under 15,000 and those incomes in those bottom quartiles continue to suffer. And it's just, they're just not willing to spend on those same levels. And to be fair, they make up, anywhere from 22 to 30% of total U.S. purchases, which again is going to just be a huge overhang as we look towards fiscal spending. What is any type of fiscal backdrop that we could get? The government just recently passed a stopgap that gets us to the middle of September, keeping the governments open, but I mean, they can barely agree on that. So to see an agreement to give additional support, especially to those lower incomes, before the election is just going to be very unlikely, which is just going to put additional pressure not only on the remainder of September, but well into throughout October, which is going to put a weak start to that Q4 as we start to project out and try to figure out, what is 2021 really going to look like.